The Reserve Bank of India has increased the repo rate by 50 basis points. Just last month, it had hiked the rate by 40 basis points. Now, the repo rate stands at 4.9%. The repo rate is the rate at which banks borrow money from RBI. This means the borrowing rate for banks has increased by almost 100 basis points. This will also increase the interest rates on loans we take from banks like home loans, car loans, personal loans, etc. So how expensive will the loans get? If you think interest rates on your loans will rise at the same pace as increase in repo rates, then you're mistaken. Because it is bond yields and not repo rate that drives the loan interest rates for you. Currently, 10-year bond yields in India is close to over 7.5%. In simple terms, Indian government is getting a loan for 10 years at the rate of 7.5%. Keep in mind that the government is the biggest and the safest borrower. Now, if the safest borrower is getting a loan at 7.5%, then we all will obviously get at a much higher rate. So that day is not far off when the rates for home and auto loans touch the double digits. Why in double digits, you might ask? That's because there is high possibility that bond yields will rise further. And when does the bond yield rise? When the inflation is high, the government is cash strapped. When the fiscal deficit is rising and the government borrows more than expected. And right now, all of these are happening. RBI expects inflation to remain above 6% for the first 3 quarters of FY 2022-23, which is above the upper limit set by the RBI. The government recently cut tax to contain this inflation. This will put a burden of 2.2 lakh crore rupees on government financials. Senior government officials said the tax revenues of the government can come down. The reduction in taxes will lead to a larger fiscal deficit, which in turn will induce higher borrowing. In FY 2023, the government is expected to borrow 14.95 lakh crore rupees. But it was that situation when the crude oil was expected to remain below $100. The global inflation has disrupted all the calculations. After the center, let's come to the states. The situation is even worse here. Average borrowing rate for states has crossed 8%, which is the highest in 2 years. After GST compensation stops, there could be a bigger need for loan. 20 states that contribute 80% to the GDP are expected to borrow 5.73 lakh crores. So, the point is that the days of cheaper loan are gone. Loans will become expensive for everyone. They will become even more expensive with higher inflation.